Good day, welcome to my trading channel Don Vic FX. I hope you find this video educative, and please you can as well click on the like and the subscribe button to receive more updates and notifications on incoming videos on how to trade the forex market, most especially the crash and boom market. I'm a trader. I train and I give signals to my students. So for further training or learning purpose, you can as well contact me, call or contact me on my WhatsApp number that will be displayed in the description section. Today, we're going to talk about how to use your Bollinger Bands, upper, lower, and middle Bollinger Bands to predict spikes and to determine the structure of the market. Also, to know when there is a support and when there is a resistance. In our previous videos, you will notice the various steps that has been taken towards predicting spike. And you will notice that the Bollinger Band has been an essential tool when predicting spikes. The function of the Bollinger Band is that, number one, it gives you the structure of the market if it's in an uptrend or a downtrend. Two, it helps you determine support and resistance zone. And this is the basic criteria that would be used when following the Bollinger Band strategy. The Bollinger Band can be determined using this tree, this first candle, which is the upper, this lower candle, which is the middle, and this last candle here, which is the what? Lower Bollinger Band. Now, let me tell you the ideology of this Bollinger Band. The Bollinger Band can act as a support and resistance or a resistance if a candlestick is not able to beat it. Let's take for example, let's use 1000 market now as a case study. As you can see, this is a series of buy. Remember, when coming into the market, the first thing you do is you check your higher time frame, which is your D1. As you can see, this has been a long buy from here to this very point, and we usually go against the market. If you notice, we usually go against the market. So imagine someone takes trade from here. This is almost, in fact, someone will be getting millions from this trade. How do you determine this kind of trade? You can determine it using your W1. As you can see what happened in W1. W1 will give you a clearer view of what will happen in D1. Remember, your higher time frame gives you a clearer view than the lower time frame. You can start from your D1. If your D1 is not clear, you go to your W1. W1 means what will happen within the whole week, from your Monday to your Sunday. That is W1 for you. It gives you everything that happens for the whole week. On Monday, it resets again. For example, this you saw here. Look at this one started. This W1 started on the 5th. This W1 started on the 5th. So it gives you a clearer view of what's going to happen in the market. From here, you would have noted that this candlestick in D1 would occur like this. Why? Why did I say so? But if you notice from here, it was able to break out from the upper Bollinger Band. It was able to break out from the upper Bollinger Band. So the present whereby it broke out from this upper Bollinger Band, we should be expecting it to have a resistance at this very spot. Why? From our previous candlestick, you will notice that I specified that you can use the previous resistance point to determine the next resistance point. If you notice, this was a, let's just say this is a resistance point here. Why? Because there was a change of candle at this very spot. The sellers took over from this very spot. So there was a change of candle. There was a change in price. The sellers stayed dominating. So we should be expecting that at this very same point again, we should be expecting a sell. So someone can from here, or let's say from this very spot when it has broken out, can use a full week from year to year to get as much money as possible. Now, at this very spot, you notice that it has overbought, like it has entered the overbought zone. And when a candlestick has overbought like this, we should be expecting a change of price. That means we should be expecting the other candle to what change price. This is a buy candle. This is a sell candle. The red candles are sell candles. The green candles are buy candles. So we should be expecting the sellers to take possession of the market at this very spot. We should be expecting the sellers to take possession of the market at this very spot. So now, from our analysis and what we have seen, we should be expecting that this week would be sell week. What we should expect this week will be sell week. Now, if you go to our D1, this is our D1 as a case study. If you notice, starting from yesterday, which our week 1 started from, see the candlestick, it became a red candlestick, a sell candlestick. So the question is, how are we going to determine if it will continue being, if the sellers will continue taking over the market? Remember, the strategy we are employing here is using Bollinger Bands as a criteria and as a case study. If you notice, when it broke out from this upper Bollinger Band, what happened? It kept on buying. How will you determine whether this will keep on buying? It's using your higher time frame, which is your W1. Look at here as a case study. Let's take here as a case study. The Bollinger Band, when it reached the upper Bollinger Band, what happened? It pushed price down. If you notice, upper Bollinger Band has been acting as a resistance, while the lower Bollinger Band has been acting as a support. If you notice, look at this direction here. When it reached the upper Bollinger Band, what happened? It got reversed to sell. When it reached the lower Bollinger Band supported it and it stayed buying. Remember, to spike, when we talk about spiking means going against the market. That means, for example, in the bull market, we target on the buy candles, while we target on the buy candles if we want to go against the market, while in the crash market, we target on the sell candles. So if you want to follow the market, you can target the red candles using 1000, vice versa for crash 1000. But the main and the best strategy to use while learning forex or while trading the forex market is the use of going against the market. Now, like I said earlier, we are using Bollinger Bands to determine. So if you notice, whenever a candlestick reaches the upper Bollinger Band, we should be expecting two things. Either it breaks out or it reverses. Either it breaks out or it gets reversed. For example, as you saw here, as it reached here, what happened? It reversed. When it reached the lower Bollinger Band, in accordance with your EMA, it got supported to become a buy candle, and when it reached your Bollinger Band here, it broke out. Now, this market has overbought, and a market that has overbought has a tendency of selling. So, as we were saying earlier, looking at this candlestick here, it's a sell candle, and from your week candlestick, we should be expecting series of what sell. Like today, this week would be the seller's week. So those who are selling, this week is going to be your week. If you check your H4 after analyzing using D1, you will notice that when it reached your middle Bollinger Band, it got reversed. If you notice, check it very well. Remember, if it was able to break this your middle Bollinger Band that you see here, it will keep on selling until it reaches the lower Bollinger Band. If you notice what has been happening here, whenever it reaches the middle Bollinger Band, it gets reversed. The buyers take control. If the sellers take control and it reaches the middle Bollinger Band, what happens? It goes up back. The middle Bollinger Band was a very strong criteria. So now, seeing this, if you notice, the middle Bollinger Band didn't have a stay here. Sorry, it had a stay here. Sorry to say, it had a stay here. It reversed this candle. It reversed this very candle that you see over here, which made the buyers to take control of the market, as you can see over here. Now, looking at this, from this very perspective that we see, remember, this recent H4 candle has not been, it's not 30 minutes long. It just started. H4 means from 1 hour to 4 hours. This one candlestick you see over here means from 1 hour to 4 hours. Is what? 1, 2, 3, 4. 4-hour candles. Let's say 4-hour candlestick in one candle. That is the same thing you see over here. From what we see here, what happens now? From analysis, we should be expecting this H4 candle to be a buy candle. And we should be expecting it from this very time now to 4 hours time, we are going to be seeing a very strong buy. Let's say a buy that might reach this very extent and get reversed to sell candle. Why did I say so? Because at this very spot, it got reversed. So it might either break this spot, and in order to determine whether to break this spot, you should be monitoring your D1 as much as possible. From D1, it's capable of breaking it. So using H4, it's capable also of breaking it. So you can go to your H1. Looking at H1, from analysis, you will see that it has reached this upper Bollinger Band. See, at this very spot, it broke out from the lower Bollinger Band and kept on selling. When there was a reversal here, what caused this reversal? Let's check it. That was around 2200. Let's check it. 2200. See, it was the middle Bollinger Band in H4 that caused this reversal in H1. Please, you guys should try as much as possible to practice this thing, especially using higher time frame. Your higher time frame will give you an insight of what truly the market is all about. Someone will ask himself, what caused this reversal at this very spot? It is your middle Bollinger Band in H4 that caused it. As you can see, a spike just occurred. That means it's telling you that the buyers want to still keep dominating until it reaches this very spot. So like I said, always use your higher time frame to determine your lower time frame. Now, it has reached this upper Bollinger Band. What is the tendency of this thing breaking out? Your H4 has given us the assurance that it's going to break out. So, for a day trader or someone that trades for hours, the person can decide to take this trade for, let's say, 4 hours, and the person will be in nice profit. But for someone who scalps the market, you can use higher time frame to analyze and lower time frame to what? Take trades in combination with price action, knowing when to take proper risks at the right spot. Price action is all about using higher time frame, repetition of the market, and what? The market trend. So if you can combine these together and take a trade in the lower time frame, you will know when to hold a trade, when to take it higher, and when to use risk management. So in order to determine when to use such for someone that scalps, you can, after analyzing your H4, H1, you can as well analyze your 30 minutes candlestick. For what I see, 30 minutes candlestick is free. There's actually no resistance point that can really hold it from spiking up, except this very spot that this candle reversed wants to be a resistance point. But from what I see, it's going to break it. So check your M15 also. M15 is free. Your M5 is also free. That means that's when you have thoroughly analyzed it. If you know to see, when it reaches your middle Bollinger Band, there's always a reversal. There's always a reversal. The same thing goes for your lower Bollinger Band and your upper Bollinger Band. So I want you guys to understand something. I will do a summary of what I just said now. Remember, your Bollinger Band acts as both support and resistance. In the case of the upper Bollinger Band, if in any process the candlestick is able to break the upper Bollinger Band, we should be expecting series of buy. If it gets reversed, as in the case here, we should be expecting series of what? Sell until it reaches the middle Bollinger Band again. If it breaks the middle Bollinger Band, we'll be experiencing series of sell until it reaches the lower Bollinger Band. If it reaches the lower Bollinger Band and it breaks it, we'll be expecting series of sell until your next higher time frame gives you a resistance point. That is the summary of using your Bollinger Band to take trade. Please try as much as possible to practice it. It occurs for all markets. This Bollinger Band method works for all market strategies, both currency pairs, stocks, and commodities. How do you set up Bollinger Band? You click on the F sign, click on your F plus symbol, then you click on your Bollinger Band. If you look at the F plus symbol, you check for Bollinger Bands. You see it over here. Click on it. You see period 20 deviation 2.00. Just copy everything you see here and click on done. I clicked back because I have done it before. So you will see it set accurately like this, these three green lines, and with that you'll be able to take trade properly. Please, if you find this video educative and you love this video, you can as well click on the like button and on the subscribe button and share it also to your friends. Thank you. Have a nice day.